but I can get a higher rate of return. When first exposed to the rationale of the infinite banking concept, a person will almost always think, and often voice the thought, but I can get a higher rate of return by investing in. Unfortunately, that person has not understood the message. We are not addressing the yield of an investment. We are discussing how you finance anything that you buy. It is always better to finance it through your banking system than out of your pocket. To demonstrate this principle, suppose that A invests $100,000 for 1 year and earns 20%. The gross yield of $20,000 less taxes at 30% or $6,000 would net yield $14,000. Suppose B builds cash value of $100,000 in his own infinite banking concept dividend-paying life insurance plan, then borrows it from his system for 8%, and then makes the same investment as A above. The results are like this. Gross yield, $20,000, less interest paid to his banking system, taxable gain of $12,000, less taxes at 30%, or $3,600, net yield $8,400. But in this case, you must remember who the characters are in the play. B also owns the policy to which interest is paid and earns the $8,000 on a non-tax basis. So the total results are like this. Net yield from investment, $8,400. Net yield from his banking system, $8,000. Total yield, $16,400. This principle applies to any investment that you might make. So there is no way that a person can get a higher rate of return by ignoring the banking process. There is a delay in time while getting the banking system established, but once this is done, it is a one-time only event. Anytime a person starts up a new business, there is a delay in time before profitability commences. When a life insurance policy is created, that is the equivalent of starting a business that never existed before, and the same phenomenon is inevitable. It is just like a trust agreement. A trust has a grantor, a trustee, and a beneficiary. The grantor puts property into a trust. The trustee takes possession and title to all the property in the trust. The trustee puts the property to work for the benefit of the grantor. When income is earned, it all goes to the trustee, but the trustee has an obligation to the grantor to carry out the mission of the trust. In such an example, you have never heard one say, "Look how much money the trustee is making." To the contrary, one says, "Look how well the trustee is doing for the benefit of the grantor and beneficiary." Otherwise, the grantor would never put property into the trust. The grantor can certainly be a place where the trustee puts property to work. In the case of a life insurance policy, the owner of the policy outranks every other place that an insurance company must put money, the equity in the owner's policy, to work. For proof of this fact, go back and study the equipment financing section of this book. A number of people have had trouble understanding that the interest B paid to the insurance company went to increase the cash value of his policy. If that is a problem to you, please study the diagram on page 26. The company has to lend money from a pool to any number of places in order to eventually pay the promised death benefit. It matters little where they put the money to work. Loans to any of the sources will increase the cash value. For even further application, please study the table below. Get out your highlighter and mark the spaces on the pages given. Page 54 illustrates the insurance company managing all the cash values. Page 59 shows what happens when he finances a truck through the policy and pays $19,400 in interest to his policy. In the first example, he has paid out more than the increase in cash value. That is because the company has still not absorbed all the cost of acquisition of the policy. This usually takes about 12 years. In the next example, the cash value increased more than the interest he paid. In the last example, the cash value increase was much greater than the interest he paid to his policy. A word of clarification is necessary here. The interest he pays the policy is not really interest on the loan. It is additional premium that is equal to the amount of interest he is paying to the finance company. Please go back to page 58 and thoroughly understand this fact.